Welcome to the Collective Genius Podcast, the show for real estate investors who are looking to scale.
Welcome into the Collective Genius Podcast, a podcast where real estate investors go when they're looking to scale and listen of the journeys of our real estate investors across the United States. Longtime CG member Mike Zlotnik is joining me today. Mike, welcome to the pod. Good to see you.
Thank you, Leon. I appreciate the opportunity. You know how funny it is? I'll just start this way. So Jason Medley, my really good friend, the founder of the Collective Genius, he would go on stage and introduce me. Hey, here is Big Mike Zlotnik, and he's been in CG for 7+ years. At least he says the plus. I cracked the joke afterwards. Jason, you either have a memory problem or a math problem, because I've been a member since 2012. Not at the very first year when it started, 2011, but I've been in the group since 2012.
That's where I was going to start. So thank you for saying that, because sometimes when you have as many members as we do, especially as we've grown over the last 5 years, you don't always remember the exact. So you say the plus just so you get away with it a little bit. But I was going to start with, I know you've been in 10+ years, because when I was first introduced to CG 10 years ago, you were already in the group. And I can't wait to tell everybody your story, because, you know, when we have members that have been in this group for as long as you have, it means that, number one, that you're getting a ton of value from it. And number two, you're giving a ton of value as well. So excited for today's conversation. Mike, I always like to start off with a proper introduction, because you are not the traditional avatar of a real estate investor per se, like single family flipper or landlord. You do something a little bit different, but obviously can give a ton of value to not only our members, but to the listeners here today. So why don't we start off with a proper introduction of who you are, where you're from, and what it is that you do in the real estate investing space.
Thank you, Leon. So I'll start by quoting James Bond movie, From Russia with Love. And I actually don't come from Russia. And Mr. Medley calls me Big Russian or Big Mike. And with the situation in Ukraine, I tell him, don't call me Big Russian. I'm actually not from Russia. The truth is I'm from Moldova. So from Moldova with love. Moldova is a small republic of what used to be the Soviet Union. I left in 1989 when it was a Soviet Union. I was a political refugee from the evil communist empire. And I came to the United States as a political refugee. I'm a U.S. citizen and a U.S. patriot. So that's my story, how I started coming to the United States in 1989 with my mother. And I've since, I guess, grown quite a bit. I have a family, 4 monkeys and a cat. Actually, my wonderful wife, 4 kids, and a cat with a family member. I live in Brooklyn, New York. I've lived actually in New York pretty much my entire life. Upstate New York, Rochester, New York. I went to school in Binghamton, New York, and I settled and got married here in Brooklyn, New York. And what else? What I do. So, many CG guys are wholesalers, novation, fix and flip. What I do is a little different. I'm a capital partner. We loan money when we invest in debt. We also invest in equity of many deals, some residential and many commercial. So commercial real estate, multifamily, self-storage, open-air shopping, industrial, number of niche strategies. For example, we do business with one of the CGCO members, discount lots guys. We loan them money and then they buy recreational land and then they sell it through their website. So we're very flexible to do commercial real estate, anything that makes great sense with the great operating partners in their strategy. We act as essentially capital partner. So we invest, we raise capital, we have funds, we have syndications, we have individual deals. So basically marry money and opportunity in real estate. That's the best way to describe it.
So when you were growing up in Moldova, what did little Mike, before he became Big Mike, what is it that you were thinking that your career would be? Because I know you as a deal architect. You're creating, you find deals and match capital. You're really good at making numbers work when the deals come to you. Were you a math? Were you someone that was you felt like you were going into math? What is it that you wanted to do?
Yeah, Leon, it's a great question. You know me, I don't like to take a lot of credits. I'm actually a very humble guy, and I respect humility. But I was a pretty smart math kid and a chess kid. I don't know how else to put it. My father was a 5-time champion of Kishinev in chess as a chess master. I became a chess master, and I became a math and science whiz. In essence, I studied a lot of mathematics, advanced mathematics. I participated in math Olympiads, and I competed in chess essentially professionally. So some other kids, I was a big guy. I'm 6'4" now. People thought, I'm really good at other sports, but I was honestly really good at math, and I was really good at chess. And that's my genius zone per se. So little Mike was a geek. I don't know how else to put it.
So, nerds, as I've said on this podcast before, rule the world now. So that's a good thing to be called these days. Maybe not in the 80s, but today it is. What did you obviously were really good at math, really good at chess, really good at figuring things out, solving problems. What did you see yourself doing? You came to the U.S., you went to college, I believe you said in upstate New York. What is it that you wanted to do?
Sure. So I spent almost 15 years in technology career, graduating degree in math with a lot of computer science. I went through almost 15-year career in technology field. So I went from rank and file member of technology teams all the way to a corporate VP, had successful career, had successful exits in technology companies. I really loved it, but at the same time, I hated this. And I mean this with all due respect. So to make long story short, I discovered real estate passively in 2000. Bought my first apartment in New York City in 2000. And then I continued to buy apartments passively in New York City. This was my sort of journey over the years. I bought 8 apartments in 2003, and I continued buying some real estate in New York City, some multifamily, small multifamily, and then some apartments just passively, purely passively. By 2009, I was burned out, tired from the computer field. And I still love the field. I still have great admiration, but I realized my passion was real estate. So I was a passive investor in real estate from 2000 until 2009. In 2009, I had a perfect opportunity to wrap up my technology career and switch to real estate full time. And I never looked back.
Where did that start? Did you know someone that you were just funding deals on the apartment side? You said passively. Did you know someone? Is that how this whole journey started for real estate?
Sure. So the way it started, actually, I have a good friend of many years, Joel Hoffman, and Joel essentially start funding short sale flips by launching originaltampafunding.com. This is the website, was launched by Joel. He realized that 2008 crisis, we actually talked about shorting the market in like 2006 as friends. He was a technology executive like me, and we were just chatting. How do we short this thing is overvalued, overpriced? And we didn't have a methodology to do it. And then 2008 happened, great financial crisis, and valuations fell, and people started doing short sales. And Joel was at that time living in the Bay Area in California, and a lot of California values corrected heavily. He launched tampafunding.com to fund short sale flips. Interestingly enough, Jason Medley was running a visionary. He was funding the same thing, short sale flips. So it was hilarious that Jason was number 1 and tampafunding.com was number 2. We were funding short sale flips, ABC flips, transactional funding, whatever you want to call it. But that's how we started. And then Joel literally did a few flips, said it ain't for me. I still love technology. Mike, won't you take over and just run it? So he turned it over to me. He remained partner for many years. He's still close friend, but he basically started it, did like 5 transactions, and then said, Mike, you take over. So I started pretty heavily 2009 funding short sale flips, and we did it quite a bit of it for a couple of years. It was a lot of need for that. And after that, we went.
Quickly made that transition. Like you went from, passively buying apartments in the city to working with a partner to fund. And many people have heard me say this on the pod before. CG started because Jason was doing transactional funding and had a lot of investors that wanted to learn from each other. And that's what the business was created from, is, a network of investors that wanted to figure out direct to seller, because the short sale market was starting to dry up in 2010 and 2011. And here comes the Collective Genius, and fully made that transition thereafter. So you got into this pretty quickly on a funding side, and has stayed there, ever since. When did you meet Jason? When did you know of this person that was doing what you guys were trying to do?
So I'm trying to remember when I met Jason, but it was pretty early. So we obviously were aware of Jason. Jason was a little bit of competition. He was doing transactional funding. We were doing this heavily 2009, 10. And then I think Jason started Collective Genius in 2011. And there was a very rapid change in the environment. Banks started to put anti-flip restrictions. So transactional funding became way, way harder in 2011 when Bank of America put 30 days anti-flip restriction, Wells Fargo 120 days, other banks put 90 days. To make long story short, I think Jason transitioned in 2011 into the Mastermind side of it. I transitioned into doing what we used to call extended funding and hard money loans. So we went to a traditional underwriting. Okay, you got to hold the property for 90 days or 120 days. Here's a loan for that. So that's how it started. I don't remember exactly when I met Jason, but somewhere between 2009 and probably, I'm guessing 2009 and 10, somewhere in that range, than when I originally met Jason.
He was starting this community back then called the Mastermind. When did you say, I need to be a part of that, and why? Because you were getting in the room with other people that you could loan money to?
The answer is pretty simple, right? Strength in numbers, community has a lot of value. I realized my genius zone wasn't trying to run a community, but being a part of the community was a great idea. So I wanted to network because we continued to fund transactional funding. So networking with folks who needed transactional funding made sense. So Jason exited the business. We picked up some of the business from Jason. He actually even referred some folks to us. So long story short, it was very complimentary. I thought it would be great to be in the room with the right aligned people to get some business, to understand where the markets are moving, because the environment was very dynamic then. It's a very dynamic environment now. So being in the right community, getting fresh market, feet on the ground updates, latest and greatest concepts, networking with people, these are all elements of a mastermind community. So to me, it was kind of a natural fit immediately.
You're one of the longest tenured members of this community. So I have to ask, over the years, what have you seen as the biggest change within the Collective Genius? Not just the increase of numbers, but just in general, the market, the type of investor, the community as a whole. I'm curious on your overall thoughts over the last 10, 12 years.
Sure. So it evolved. There's been waves. The format was different. I actually really like the old format. I like the current format a little bit less, but the current format. Let me state it this way. So I went through cycles on that opinion. I like the small group community. Then I actually like the current outcome. And then I honestly prefer the current format. So I misstated this. I like the current format more and better than the previous one because my time is very busy. And being in the room for 2 days with presentations is a little bit restrictive to me. So the current format works way, way better. Over the years, I've seen a lot of evolutions, right? Obviously, community grew in terms of numbers. You got high caliber folks who doing bigger volume per se, right? You've got I've seen waves of some commercial folks have entered that then they kind of exited, and I think the commercial side of it is regrowing again. But what I discovered is we used to get business out of the community loaning money for these flips. But recently, last few years, I discovered that there's a very different value for me in the community. The role that I play today is very different from the years ago. There are many other funders they do hard money lending today, right? And I want to compete with them. I never really wanted to do that. The value we bring today is we actually bring the deals, commercial deals that give members heavy depreciation. We'll talk about that in a little bit later. Sure. But we started to structure deals where there's a big need. So 90% of the community, if not higher, are real estate professionals. Many of these folks make money in real estate, flipping, wholesaling, wholetailing, using innovation, other methods. But they need a tax deduction. So we started serving the community by virtue of structuring the deals with heavy depreciation. People will put $1 and get $2 of bonus depreciation out as a way to immediately mitigate taxes. So I've discovered that that part of the need and start serving it. And financial engineering is my genius zone. I talk about genius zone all day long. Something I love to do. I'm good at it, and I'm really productive at this. And that's what I'm trying to do. It's been an evolution of different needs for different strokes for different folks. But I'm still learning quite a lot. Just coming from the last couple of CGs. I can say that there's been great presentations on AI, and as world is evolving and new technology is coming forward, to me, it's a constant learning evolution. It's a networking, plus figuring out how I can click and work with existing members. So it's been an evolution. I don't know how else to put it. From my eyes, it's a great community, but I don't do much in Resi. But I could serve Resi investors by giving them access to commercial deals that are both great investments and give them tax mitigation strategies. I don't know if that solves from my view.
Yeah, it gives me a great summary of how things have changed, not only for the community, but for also your perspective and how your business has evolved as well as you're serving a different individual. That individual obviously is vetted. They're in the group because they do X amount of volume and or revenue, and in that particular case, in most cases, most of them are above $2 million of gross profit. As you mentioned, most of them had high tax bills and may not have ways to offset those taxes. So,
by the way, let me add one more benefit, really important benefit, and I want to give credit where it's due. So I met some other great fund managers like me in the community who I work closely with jointly when tackling bigger elephants. So some of the larger deals I do together with a few other fund managers. I work closely without mentioning names. You already know who these folks are, but I've developed close friendships, and we work together because they have ability to raise capital because they do something similar, and as a result, strength for numbers enables us to do bigger and better deals.
Yeah, love that add-on. You were talking about basketball before the show. That's a tip dunk right there. That's a nice throw in after the fact. I love that addition. Let me transition a little bit here on, you were mentioning, funding, finding deals and then offering depreciation. A lot of times, those deals that you are bringing are deals in which, people would want to invest in, but don't know how to vet. I want to take this on the other side. When you're looking at deals that are you are a deal architect. You are investing in the individual more so than you are even the deal itself. So I want to take this moment for those that are listening to this that are making that transition into commercial or doing commercial and looking for money, or looking to be, to get in front of people like yourself to be vetted properly. What do you look for when you're doing a potential deal with someone that they brought this unbelievable project to you, commercial, what have you? What is it that you're looking for to invest in?
Yeah, it's a great question. So I'll give you the whole theory, and I'll try to keep it short. So the theory is jockey ahead of the horse. So we're looking for, as much as we can, institutional quality sponsors, but non-institutional size. That's the best way to describe it. So what is institutional quality means? Folks who are really well organized. It's not one man show, one woman show. It's an organization. with ability to identify deals in their niche. It doesn't have to be jack of all trades, but there has to be a specialist in a given strategy, ideally certain cities or certain markets. We'd like to see vertical integration. So ability to execute their strategy in their markets with their own property management, with their own supply chain, and related, with their own construction as necessary. And then be able to report well, be able to communicate well. So all those things are part of the underwriting of the sponsor, of the jockey. Then we go into the horse. Then we go into the deal, right? So the first step is, of course, know, like, and trust whoever you want to invest with. And it takes time. We've been building these relationships over the years by going to other mastermind communities and conferences, connecting with sponsors and operators in their specialty. It's not easy to get there. We're looking typically, as I said, well-organized specialists. If you're in a given market or submarkets and you are focused on either multifamily or industrial or whatever your strategy, if you can demonstrate that you're very good at that and you are well organized and you can show how you've managed past deals, you can demonstrate capability. Real estate moves slow, so we are very, very mindful that you may not have exited some of these deals, but we want to see how you work these deals, where they are in the middle of the process, et cetera, et cetera. So jockey first, then we look at the deals. So our evolution of deal underwriting is also evolved. This is an evolving process, just to be very clear. We are not underwriting the same way today, the way we were a few years ago, including the sponsors. So today it's a lot more conservative. I don't know how else to put it, but we are looking for more downside protected deals and downside protected lower leverage, more conservative underwriting. At the same time, the crazy part is still great upside because the market conditions have reset. So again, we're doing this in the middle of 2025, and the market conditions for commercial real estate have gotten way better for the buyers. So as a buyer, you can get much better deals. As a result, we're not looking for any deal. We're looking for a great deal. So a great deal means asymmetric return versus risk profile. Upside should still be great because you're buying deep. And we need to see that, and we need to see the downside protection. And then, of course, we want to see great upside. But things have changed. And our underwriting has changed with that. And the mindset has changed with that. And I strongly believe today, when you go into commercial real estate, you're getting phenomenal deals. And data supports this. We've seen discounts to the peak of the market to the degree, let's call it 30 to 40%. So if you can pick up something today at that type of discount and execute really well, and on top of all this, because the valuations have corrected so much, so many deals today actually start with good cash flow. The crazy part, a few years ago, you had negative spread in commercial between the cap rate that you pay. And for those who don't know the cap rate, it's a term used in commercial real estate. It's the yield on your purchase price without leverage. So if you buy something for $10 million and you get $600,000 a year in net operating income, revenues minus expenses, but not including the mortgage, that's 6% cap rate. So in the past, that was a negative ratio. You would borrow money at the interest rate higher than the cap rate on your purchase, which was crazy. That was the market overvalued. Today, you get a positive spread of, for example, 200 basis points. So we're buying deals right now in multifamily. I have a deal we did in Q1. 9 cap on purchase, 9% cap rate, and a mortgage financed at 7. That's a positive spread of 200 basis points. When you have that, you can be 100% sure the deal will cash flow well from day one. And I'm going to stop for a second.
Well, I appreciate you stopping there. So many numbers, but I will say this. What my question originally was is who are you looking, obviously with these type of deals, they're already, people that you're vetting through Collective Genius. But if I am someone on the outside, you're betting on the jockey first and then the horse second. So let's use this example as a follow-up. Right now with deals being so good, let's say I'm a first-time jockey, but I got a heck of a horse. What's your advice for that individual?
Yeah, it's a great question. Yeah, the immediate response is find a partner who has a strong history. So most people don't want to share the. You honestly need that for multiple reasons. So with commercial deals, a little different from residential. Commercial deals, you can partner, and there's a few different partners. You have credit partners. You have somebody who has the balance sheet and the credit to be able to get through the tough bank underwriting. You have an experienced partner. When banks are underwriting, they want to see somebody with a track record in this field. So by bringing in maybe one person, credit and experienced partner, and sharing the upside with them, of course, but getting some of their track record, experience, and history, that'll immediately enable you to have a better credit in the form of you're leveraging on the experience and a track record to bring the deal forward. So first couple of deals, having an experienced partner will actually enhance your sellability to potential investors and banks.
Love that answer. I think it's the best feedback for anyone that, especially getting into whether it's self-storage or mixed use or conversions. I hear a lot of those come our way with our single family people that run into these type of deals. And the first question they ask is, hey, who can help me fund this? And like, you're asking the wrong question. It should be, who can you get the partner that has the experience with this type of asset so you can win and also learn at the same time so you can continue down that road should you choose. All right. So now that
I'll add one comment on this.
Sure.
So Scott Myers is a super veteran in the group. He does self-storage, economy, all that stuff. So years ago, and I had all this conversation with him. He said, I got a student in my self-storage economy. Says, Scott, I will do the deal with the student if you are a partner. If I know you will put your track record, our relationship on the line, that you will be behind the deal, then I'll work with your student because I'm working with you. So that's a classic example where you have a new aspiring member come forward with the expert in the field. That'll add instant credibility. That's an example, live example.
Great example. All right, Mike, I trust your opinion a lot on real estate, your experience, your expertise, obviously your math skills. I don't expect that you ever have a crystal ball, but you're one that I trust your opinion on what you see. And I know that right now, every investor is looking at their particular region, their particular area, and the country as a whole as it relates to real estate. Gone are the days of milk and honey, 2020 through 21, those 2 great years that everybody had where the market was just not real. Obviously, we've come back down to earth. Over the next 6 to 12 months, again, not expecting a crystal ball, but in preparation, what would you say to investors that you see in the market and the trends that you see moving forward?
Well, my crystal ball broke. I can't find none for sale. You know the drill, right?
Yes.
So it's difficult to say. All I can tell you is that in commercial, and it's a little different in residential. So what my observation, again, commercial real estate, especially multifamily, it's been less for other asset classes. So I need to be a little bit more specific. Certain asset classes, subclasses, have gone through a market cycle. And there's a great book, by the way, for those. I think you'll probably want me to recommend a book. I'll start with one right now called Mastering the Market Cycle by Howard Marks. So he's more of a stock market investor, but the book is fundamental. So understanding market cycle in real estate is fundamentally important. What we have seen is multifamily, for example, have gone through a substantial correction in the market cycle. Now, many other commercial asset classes have gone through some level of corrections or cap rate expansion. This is the fancy term. People used to pay, as an example, higher price, lower cap rate. Today, they're paying higher cap rate, lower price in other asset classes. So, but multifamily, I'm using this as an example. So the cap rates have expanded and you can get way better deals. And evaluations have corrected anywhere from, let's call it from 20 to 40%, more like 30 to 35%. We've seen that range. Some deals are 25, some deals 30, some deals are 35. So from a market cycle perspective, if you can get into a great deal today with a strong cash flow, with a conservative leverage, it's almost like you're not looking for perfection. You're not looking for the bottom of the market. We're somewhere near the bottom, approaching the bottom of the market. I would say opportunities are great if you can find it. From a market cycle perspective, that's one region that's doing really well. We've also seen some other asset classes that have gone through some cap rate expansion, essentially more interesting valuations for the buyers, but the market has not been oversupplied. Multifamily has also been oversupplied. That's another part of the market dynamics. So as the market has gotten oversupplied, you're seeing slower rent growth, you're seeing valuations corrected, and it's the deeper buys. Inevitably, U.S. still is a great country to be. Over time, we will still see a ton of capital inflow, and this will continue to be a great place to invest. So the opportunity is now to be more, to have courage to act. So people, you know what Warren Buffett says, be fearful when others are, be greedy when others are fearful, be fearful when others are greedy. There's a lot of fear right now, concern, uncertainty, and that's the time to come in. So commercial real estate market has corrected because the interest rate spiked. Fast and furious, Fed hikes, dislocated the market reset. So I believe the opportunity is great there. On a resi front, I'll be very careful because it's market by market. We've seen lots of markets did not correct, and some other ones at beginning or have already started the correction. Because the correction hasn't really taken place, I'd be very careful. Some markets may continue to correct in certain parts of the country. On a commercial side, there may be some further correction, but I see risk reward, asymmetric return upside if you can find a great deep value buy. So I don't know if that answers the question. On a big picture, I feel you got to have the courage. You got to find the capital or the capital partners to get the deals done and continue to look for these deals. And when you buy a deal with fundamentally strong KPIs, you can't go wrong. If you're buying with a positive spread, you lock in. Just give you an example of a deal we're doing right now, and then I'll shut up. We're doing a deal in San Diego, open air shopping, called headquarters at Seaport, literally at Seaport. And we're buying the asset, the operating partner, we're a capital partner on the deal, buying the asset at 9.25% cap rate and borrowing the money at 6.5% fixed interest rate for 10 years with prepayment penalty burning off after 5 years. So you look at that, and it's only at 83% occupied. You have upside through lease up, you have locked in debt, you have high credit quality tenants, which is, by the way, an example of why we love real estate. You can have industrial, you can have open air shopping, you have the Starbuckses of the world, you have the Cheesecake Factory, you have a number of these national chains that are in the asset. When you look at that, you have predictability of the cash flow. You have a positive spread, as I mentioned, which generates a ton of cash. Plus, you have downside protection, low leverage. The deal is only 57% leverage. And you look at all these factors, and it says it's a very defensive, very conservative deal. But my upside is still very strong. You can easily generate, call it 20% plus return to investors. That's what we're looking for today, and that's what great deals look like today. As an investor, this is the mindset to have these great deals. Oh, and you can go through other metrics below, reconstruction cost, a number of other ones. These are fundamental underwriting methodologies that tell you it doesn't matter if the market corrects a little bit more. You're buying great today. If the market finds a bottom in 3 months, that's okay. If maybe the bottom has already been formed, we don't know that. Right now, we're living in the world of a little bit of global geopolitical, the wars, the volatility, uncertainty, but that's the time to act. That's the best time to act because you're finding the best opportunities.
Wonderful answer, Mike. Thank you for that. You gave me a perfect segue from the commercial side. You mentioned that particular open air commercial deal in San Diego. Is there anything that you're seeing right now that is penciling better than others on the commercial side? Types of deals.
Well, we don't do heavy volume. Let's just be very, very clear. And what we don't do versus some other investors, people ask me the question, how many deals do you go through before you write a check? And I tell them, I don't do heavy volume of deals. And most of the deals that come to us, they come heavily pre-vetted by the top partners that we've done business with over the years. So the difference is, if you are an operating underwriter who are looking at 100 deals, maybe you're trying to do one or two. For us, we get pre-vetted deals, and we typically select, one out of four, if not, even less, one out of three. But these deals that are coming, they're insane liquid deals. So I continue to think you can get phenomenal deals in multifamily. We're not doing heavy volume. We're just doing bigger deals, fewer bigger deals, or bigger and better deals, just to be very clear. So you could find a deal of a large size, or you could find a deal of a normal size. So normal size multifamily, for example, is 200, 300 doors. We had a great deal in Q1, or 1,046 doors, because it was just the operator who we work with. They are comfortable working in that size space. But whatever is your comfort zone, whatever your market, look for the motivated seller situation. You got to have a story. You got to be a reason why a seller is selling. So it's either financial pressures, capital stack pressures, they have floating rate debt, or they have to sell, they're old, some other circumstances. So most people already look for this, seller motivation. And then you figure out how you structure the deal, how much debt you want to take. This is actually where we come in quite often, because this is we're happy to help folks. This is my genius zone personally. If you have a great deal and you're a great operator, we'll figure out how to finance the deal. It's almost funny. People say, where do I find the money? Well, find a great deal. I don't want to call the money is the easy part. It's gotten harder for sure, capital raising. Sure. But we'll figure out how to finance the deal with us and our partners.
You're really good at, and you're always the go-to when it comes to being creative to make, to have a great deal on how to structure it where someone else doesn't know how to structure it. So this leads me to my next question. You know how every once in a while you'll see like an actor passed up an opportunity to play a role, and that movie became, this massive, massive hit. Like The Matrix comes to mind. There was a couple big names that did not take that role that Keanu Reeves ended up getting. So have you underwritten a deal that you wish you would have done that you didn't end up? Any examples that you can think of where you had this killer deal and for some reason you couldn't pull the trigger and you wish you would have done that deal?
Don't regret the past. Move forward. I'll give you a story that is stuck in my mind. Has nothing to do with real estate. Has nothing to do with the deals that I've done. But in my technology career, I had a job in '96 for a technology company. I met phenomenal guys. I'm friends with them today. They're just phenomenal, brilliant, smart guys. But here's the story how it goes. And life goes on. Life is full of these type of situations. And what can you do? Sometimes you just move on, and sometimes you miss that situation. But here's the situation. These guys had an opportunity to follow one of the two leaders that were working at Deutsche Bank in New York. And there were two guys. One was doing this high-tech certificate authority for the, let's just call it encryption certificate authority startup that I went to work for. Ultimately, these guys went to work follow one leader. And this is how I met them. And they had another option. And I'm just going to tell you a couple of things and you're going to recognize who it is. There was this crazy guy walking on the floor looking for money for this startup idea or for people to follow him on this crazy, stupid idea to sell books on the internet. Jeff Bezos was hanging around and raising money before he was there. So these guys could have followed him and they didn't. So talking about extreme. So I know these guys and they didn't follow. So I don't go and regret not doing a deal. You almost don't remember it. Yes, you see a great deal, but it's not part of you. It's to this point, I'm going to make this comment. Do I sit regret? And no, you just move on. I have a friend who was telling me about Bitcoin when it was $50 a Bitcoin. That's all I'm going to say, right? And mathematician and not seeing the real value. I did my share of Bitcoin buying, but I bought way later, much less. And these stories exist every day. So what are you going to do? you're gonna bite your elbows and trying to get upset about something that you could have done.
Yep.
You just move on. Life goes on, and you know, we've had our successes, and we can talk about those, but left opportunity, not done opportunity. You just kind of think about it and say, listen, you know, the luck didn't go my way, or I didn't see something that I could have seen, and that's life.
Life goes on. What are you most? I know there was a time frame there where everyone was super excited about Bitcoin and digital currency in general. Right now, you as a business owner, you as a lender, you as, you know, someone that invests in deals, what are you most excited about right now?
So opportunities in commercial real estate because of that asymmetric return. I'm using this term purposefully because it's a risk reward. There's an asymmetric return. We are at the right time in the market cycle. So market cycle has 4 phases. It usually starts with a recovery phase, then you have expansion, then you have oversupply, and then you have recession. So we are sort of towards the very bottom of the recession, likely in the recovery phase, somewhere on commercial real estate because of the reset that took place. I'm very excited about the opportunities of fund because when you go into that market at the early part of the recovery, you have a lot of upside from that perspective. On the other side, I've talked about this, and I've talked to my Bitcoin friend. They have a ton of profits that they have in crypto and Bitcoin, to be very specific. And some people differentiate between Bitcoin and crypto, and it's another conversation. I'm not going to get into that. My good friend, the Bitcoin guy, says it's Bitcoin, and then the rest of the garbage. And then there's other people who say, well, you know, it's a difference of opinion. But the point is, they're sitting on heavily appreciated assets. It's the same story as if you are an early investor in Nvidia or Bitcoin. You've done incredibly well, right? It only makes sense to take some profits off the table and to diversify into something that is relatively very inexpensive and relatively great buy. And for no other reason, you're doing it just makes sense to diversify. I don't know how else to put it. The other thing is, I'll tell you, is one thing is a Bitcoin, the other thing is a stock market. I believe it's in many ways substantially overpriced relative to the PE. So in Bitcoin, I don't know how to measure it. I'm not saying anything negative, neither positive. I just don't know how to measure what the future and potential of Bitcoin. And people talk about it's a hedge, it's a digital gold, it's a hedge against governments printing money. I completely respect that opinion. I have no comments on that, nothing negative to say. But what I do know is it is only prudent to diversify. On the stock market side, your PEs of 30, historically, that's way too high, an S&P 500, for example, and they need to revert to the mean. So for those investors who are sitting pretty in these very, very appreciated, successful investments, that's wonderful. Consider rebalancing your portfolio, consider taking some chips off the table and going to what today is relatively greater value. So what I'm excited about, upcoming commercial real estate deals with great operators at the great valuation and the risk-reward ratio on the upside of these deals, relatively well understood mitigated risk, and a substantial upside in what I'm seeing.
I knew there would be an opportunity for me to get back to the depreciation that you have offered to a lot of members within this group, and this is a perfect time to do that, as you were talking about taking chips off the table, but also the assistance that you have transitioned to within CG, the value add that you have brought over the years, especially 2019, 2020, 2021. And even today, there are regions and pockets where we have members that are just absolutely crushing, and they don't necessarily hold assets, whether that be single family or multifamily or any type of commercial assets. And they don't really have that experience, but they're sitting on a massive tax bill come 2025 or even prior to in 2024. This is something that I know that you've transitioned to. Let's talk about that, how you help people offset with investing into these projects and how that works within the community.
Sure. So the first Formal disclaimer, no advice of any kind, right? I'm not a CPA, I'm not an attorney, I don't give advice, period. But certainly, we know how to structure deals. And what we've seen is we start with a great deal. So we start with a great deal, great asset being bought. I'll give you an example of a deal we did in Q1. And we expect to do at least one more deal in Q3 or Q4 with this very similar structure. So let me start with the renewal of the 2017 Jobs Act and the 100% bonus depreciation. It's a critical requirement. It looks like it's going to pass. We're recording this. I don't know if it's going to pass or not. Obviously, Senate, House, they have some negotiations. But it's one item that they're not fighting on. It's something that is very likely to pass. So as 100% bonus depreciation comes back from, I think if you acquired the deal from the day Trump took office, right? He wanted to, usually do it for January 1st, but for some reason, I think the bill is from the day he took office, whatever it means. We're well past that. So how do we structure these deals? We start with a great deal. And then we talk about, okay, what kind of debt leverage we're going to use. We try to be conservative. Normally today, conservative leverage on multifamily, 70% is reasonable. And then you talk about equity. And we basically break equity into two parts, preferred and common. And what we do is we make preferred equity take no depreciation. It sort of quacks like a secondary debt. It acts like debt. It has higher safety of return of capital. They get priority of the cash flow distribution, but they don't get any depreciations. And it's a critical required component. And then we give all that depreciation to common equity. So what it does, it creates outsized depreciation benefits to common equity investors. Now, common equity are taking more risk, no question about that on a capital stack. So lowest risk is primary debt, then you can call it preferred equity, and then the common equity. It's a higher risk, but it's got higher upside potential. It's got all the massive tax benefits. But the beauty about this, if you're buying very, very deep, you're buying the asset at a great price. Where do you want to be on a capital stack? Do you want to be the lender with the lowest return? Do you want to be the pref equity with no tax benefits, decent return? Or do you want to be the common equity where your upside is the highest? Because you're buying the deal so deep, in my view, and for many real estate professionals, it's a no-brainer decision being the common equity. You get massive tax benefits. So what does it mean? And how does it work for many CG guys and other real estate professionals? So the way it works is most people make their income in their niche. They could be flipping land. They could be flipping wholesaling, fix and flipping, any active business. And they could be making multiple millions of dollars. One of the CG guys reached out to me and said, hey, I got a $10 million situation. I need a deduction to the degree of $10 million. Okay, that's wonderful. Let's talk about it. Let's work about it. So that's the income. That's the money they make. Now, how do you solve it? Well, what you can do is you're a real estate professional, which they accomplish through their own activities, the 750 hours, et cetera, et cetera. But they need to own some rental real estate. It's one of the important requirements. People need to have some rentals where they actually clock 500 hours. This is a technical requirement. So I'm not going to spend much time. You have to be an REP. You got to have typically 500 hours materially participating in rental real estate. So you got to have some properties, 1, 2, 3, whatever properties, where you actually are involved managing them. And many people already do that, part of a day in and day out business. If they own a small rental portfolio, that does the trick. Now, third component of it, and this is where we come in. The REP, they have the rental real estate, they meet that requirement. Now they can take passive losses from investment in other real estate and make them active through a thing called grouping election. So CPAs would be able to explain, but they can group losses from the deals where they invest passively. Write a check into real estate syndication, common equity, put $1 million, and let's just say the deal is structured to give them $2 million loss. They take the $2 million and they can use it through grouping election to offset the active income from flipping houses or wholesaling, et cetera, et cetera. Consult with your CPA, of course. I just want to make sure that, but that's just how it works structurally. Doesn't have to be $1 million. Could be 200,000. Could be 300,000. Could be 100,000. Whatever the number works for them. But what we've been able to figure out through that structure is people write a check. We've had deals where they write a check for 100K and they get 300,000, 3x. Now 3x is very hard. It usually requires very high leverage. Today, the deal we did in Q1 called Waverly on the Lake. It had a 2x leverage. So $1 million check generated $2 million loss. Folks take the $2 million, they write it against their current income. They get massive tax savings. Almost how the entire investment is paid for in the form of tax savings, right? And then on the back of the deal, this is a really interesting thing that happens. On the back of the deal, what they get is they get bigger capital gains. So they actually they do an arbitrage between current income rate and a capital gains rate on the back end. It's kind of funny how it functions. You get a deduction today, you get time value of money, right? And then you get an arbitrage between the current income rate and capital gains rate. All that is a CPA conversation, but it's very powerful what it can do for many investors. And on top of all that, if they invest in a great deal, which is, by the way, that's the most important thing. Tax saving is the number 2 thing. The number 1 thing is it's a great deal. You're not investing to lose the money. You're investing to actually get a good return. I would like to say a great return, but let's just call it good return, solid return, and you get the tax benefits.
So when I hear that answer, and I know most people listening to this, hopefully you hear what I hear, which is when I have these type of situations come up, I've done really, really well, and I'm not quite sure how to offset. Maybe I'm not holding in 2025 and I need offsets. Mike is the person that I go to, and I would encourage you to do the same. Mike, if someone wanted to reach out to you, how do they find TF Management? How do they find you if they have these type of questions?
Fairly easy and cheesy. So Big Mike, right? I think I want to give credit originally to an old-time member of CG, Corey Boldright, my close friend of many years. And I was working with Corey close in the past, close friendship, and I was starting a podcast. So I have a podcast called Big Mike Fund Podcast, and he helped me come up with a name. He literally said, "You're Big Mike, you're a fund manager, so bigmikefund.com. And if you misspell it, you forget the D at the end, you go to bigmikefund.com. I promise it's not a kinky site."
Anything else you want to share with the audience that maybe you're excited about or something that you're working on right now before we get out of here?
Not much other than balance your hard work with your family. I do this all the time. And some of the questions people have asked me, how do you balance kind of, your personal with your family life with your hard work? And I'll just tell you, so I have 3 girls and a boy. My girls are the older ones, and third girl is a professional figure skater, synchronized figure skater to be exact. And here is I'm gonna finish with another joke, so I'll tell you the whole story. So I spent a lot of time. Synchronized figure skating has 20 girls on the team. 16 typically compete on ice. It's a very, very cool sport. For those who have never seen, go on YouTube. Type synchronized figure skating championship, the U.S. Open or World Open. So my third girl, she's on number 2 team in the United States. They took second at the U.S. Nationals and third in the world. They're very, very, very good. They practice very, very hard. And as a parent, I'm very proud. But we have to drive girls to skating, and they practice a lot. And we have 3 girls from Brooklyn, New York on the team of 20. We basically carpool together, and I have to drive typically at least once, sometimes twice a week. And they practice in Stamford, Connecticut, other places. It's a long drive. So I spend a lot of time on the road. I work on the road, so I talk. I do my business at the figure skating ring. While they're skating, I am on an iPad or I'm talking to people, et cetera, et cetera. But here's the joke. People ask, okay, your daughter is a figure skater. What about you? Can you skate? And I tell them, listen, have you ever been to circus? You ever seen bears on ice? That's me.
because you're sitting down. For those that are watching this on YouTube, it's a little harder for them to see that, but I can tell you Big Mike is definitely Big Mike for sure, and that would be a sight to see you on skates. It's almost like seeing me with my skinny little legs and on ice. They don't go well together. You should be very proud. That's of not only your accomplishments, but obviously your family's as well. Again, if people want to get in touch with you, Mike, give me that site one more time.
BigMikeFund.com. It's Tempo Funding, the corporate site, but the easy one to remember, BigMikeFund.com.
Well, I appreciate your time here today. Thanks for joining me. And just know that, you are the epitome of the Collective Genius member. You've given for a very, very long time within this community. And I know that you're always somebody that when I need to make a connection in regards to, commercial deals, funding, deal structure especially, you're always willing to jump on a call. I remember when I first joined 10 years ago, we were starting a fund and you took the time out of your day. You may not even remember that, but 10 years ago, you took the time to talk to me. You had barely met me on my first meeting, and you took a call with me to help me understand how to set up my very first fund. So that's the type of giver you've been since the day I met you. And just know that you're much appreciated, not only by me, but a lot of people in this community.
You're too kind. I'm so grateful for the opportunity to serve. It's a wonderful community. I've always really enjoyed helping people. So thank you for your kind word.
Very much so. Thank you for your time as well, Mike. And thank you all for listening to the Collective Genius podcast. Obviously, if you would love to be in the room with members like Mike and others that we've had on this podcast, the best way to do that is go to our website, explorecg.com. That's explorecg.com. There you will find an application. Fill that application out, and you will talk to somebody like myself on the other side. If there's a good fit there, we can talk about next steps. And obviously, if you're a full-time real estate investor, I can't think of many reasons why you wouldn't want to join a community like this. So again, that's explorecg.com. For now, we will end this episode and move on to the next one. We'll see you next week on the Collective Genius podcast.
New episodes every week. To learn more, visit explorecg.com, where real estate investors come to scale.